Do you realize that 70% of Americans can't afford a $400,000 home anymore? And, with home prices climbing faster than incomes, this crisis isn't slowing down. In this video, we'll expose the alarming numbers behind the affordability gap and what this means for your future. Is owning a home even possible today? The dream of homeownership? A fading ideal? Owning a home has always been more than just having a roof over your head. For generations in America, it symbolized stability, wealth, and even a sense of accomplishment. It was a sign that you'd made it. After all, there was a time when buying a house wasn't just seen as a milestone, it was practically expected. You'd find a decent paying job, save up a little, and one day, sign the dotted line on a house you could comfortably afford. Fast forward to today, and this once reliable formula feels like a relic of the past. Let's take a step back in time for some perspective. In 1971, the median home price in the US was around $25,200. Adjusted for inflation, that's roughly $190,000 in today's dollars. Back then, homes typically cost about 2.6 times the average worker's annual income. It meant owning a home wasn't just feasible. It was expected for most middle-class families. Now, let's compare that to 2025, where today's median home price has soared to $428,000. For the average American, homes now cost about 5.7 times their annual income, making the financial gap wider than it's ever been. That leap shows just how far out of reach the dream has become. But home prices are just part of the equation. Let's not forget what's happening with wages, or rather, what isn't happening. Incomes have barely budged when adjusted for inflation. While housing costs have skyrocketed over the decades, wages have grown at a much slower pace. In fact, a CNN poll found that an overwhelming 86% of renters still aspire to own their own home. But here's the catch. 54% of them believe they'll never get there. What does that tell you? It's not that people don't want to buy homes anymore. The desire is still strong, maybe even stronger because of how unattainable it feels. What's changed is the playing field. Today's home buyer faces unique challenges, ones that didn't exist 40 or 50 years ago. Interest rates have soared higher than they've been in decades, further inflating monthly mortgage payments. And with today's limited housing supply, competition has become fierce, pushing prices even higher. On top of that, we're seeing more and more homes being snapped up by corporations or investors, further tipping the scales away from individual buyers. It leads to a growing feeling among many that no matter how hard they work or how much they save, it just won't be enough. Take Sarah, for example, a 32-year-old teacher who's been renting in the Midwest. After 8 years of saving, she finally managed to scrape together $30,000 for a down payment, only to find that the homes in her price range were either outbid by cash buyers or deemed fixer-uppers that required more money than she had to spare. Stories like Sarah's aren't uncommon. They represent the frustrations and doubts of millions of would-be homeowners who feel squeezed out of the market. Even for those who work in industries with higher-paying jobs, the challenge remains. Because if wages alone can't keep up, how are savings supposed to? A dual-income household that might have comfortably afforded a modest home a generation ago can now struggle to make mortgage payments and meet the rising costs of essentials like healthcare, childcare, and student loans. And the mental impact of repeatedly falling short isn't to be overlooked. We're seeing people question whether they'll ever experience the stability that homeownership once promised. Of course, this shift isn't just about money. It goes deeper than economics. For a long time, buying a home represented more than just financial security. It was about building generational wealth. having a sense of control over your future, and showing that you'd succeeded in life. But now, the gap between that dream and reality has forced people to reconsider what success even looks like. Many are realizing that the idea of homeownership, as it was traditionally defined, no longer fits into their lives the way it used to. The changes in the housing market aren't just a reflection of personal financial struggles. They're the result of a system that seems to be working against individual buyers. A lot of people point to corporate buying, limited supply, and rising material costs as reasons behind the affordability crisis. And while those are important factors, they're only part of the picture. The deeper issue might be cultural. The way we view homes, as investments, as status symbols, as something tied to our identities, has added pressure to a system that's already stretched thin. At its core, the housing market feels like it's shifted away from serving people and towards maximizing profits. So, where does that leave the modern American dream? It's not gone exactly, but for many, it feels further away than it ever has. What used to be considered a standard part of adulthood now feels like a distant goal, something to hope for rather than plan on. And that says something not just about individual buyers, but about the way housing itself is evolving. The bottom line is this: a fundamental shift has happened, and it's leaving millions of Americans asking one big question. If homeownership is slipping out of reach, what's next? Let's take a closer look at the forces behind these skyrocketing home prices, and why owning a home feels so much harder than it used to. Why homes are so expensive, and who's to blame? At $428,000, the median home price in 2025 feels more like a fantasy than an actual possibility for millions of Americans. But what's driving these record-breaking prices? To understand that, we need to look at the forces shaping today's housing market. It's a combination of limited supply, relentless demand, rising construction costs, and higher mortgage rates all coming together to create a perfect storm. Let's start with supply, or rather, the lack of it. Right now, the US is about 4.5 to 5 million homes short of what's needed to meet demand. That's a staggering number that explains a lot about why prices have surged. When there aren't enough houses to go around, the ones that do come on the market get snapped up fast, and usually above the asking price. So, why don't we just build more homes? Well, it's not that simple. Land has become increasingly scarce and expensive, especially near job hubs. In many communities, local opposition to new construction, often called NIMBYism, not in my backyard, creates additional roadblocks. This combination of expensive land and local pushback keeps housing supply tight, driving prices even higher. Then there's the kind of housing that's being built. Builders tend to focus on luxury properties because that's where the biggest profit margins are. High construction costs, driven by everything from inflation to tariffs on key materials like steel and lumber, make it harder to turn a profit on affordable housing. For example, a $200,000 home might require nearly as much in construction costs as a $500,000 home, but the profit isn't nearly as appealing. So, more developers lean toward the higher end of the market, leaving middle-class buyers with fewer and fewer options. It's worth noting that the cost of materials isn't just a minor factor. A 25% tariff on imported steel and aluminum, implemented a few years ago, has made multifamily construction projects much more expensive and discouraged builders from starting new projects. That doesn't just affect potential homeowners. It's also part of why rent prices remain stubbornly high in many cities. Now, let's talk about interest rates, because they're not just a technical detail, they're reshaping who can actually afford to buy a home. Mortgage rates currently hover around 6.5% to 7%, depending on market fluctuations. To put that into perspective, Buying a $200,000 home at a 6.5% interest rate means you'd need an annual income of about $61,487, according to industry estimates. That's assuming you have good credit and a solid down payment saved up, which adds pressure if you don't. For those looking at homes in higher price brackets, the monthly payments can be downright unaffordable, especially when incomes have barely kept pace with inflation for the last few decades. Another component driving prices is demand. During the pandemic, historically low mortgage rates set off a buying frenzy, with countless people realizing they wanted more space or relocating due to remote work flexibility. Even though rates have risen sharply since then, that high demand hasn't gone away entirely. Housing is still seen as one of the safest long-term investments, so buyers keep entering the market, even if it means stretching their budgets to the breaking point. Add to this the fact that some corporations and investors have started buying up single-family homes to rent out, further shrinking the pool of available properties for individual buyers. When big players are willing to outbid regular families, it becomes even harder for people to find an affordable home. Then there's the matter of stagnant wages. Even as costs for everything from grocery bills to childcare have climbed, paychecks haven't really caught up. Back in the 1970s, the typical first-time buyer didn't need to spend more than 15 to 20% of their income on housing. Today, many buyers are spending closer to 30 to 40%, leaving little room for anything else. This affordability crisis doesn't just make it harder to buy a home, it directly impacts people's ability to start families, save for the future, or even consider retirement someday. The result of all these factors? Fewer homes, priced higher than ever, with fewer people able to afford them. It creates a vicious cycle. High prices keep many would-be sellers from listing their homes since they often can't afford to upgrade to a more expensive one themselves. This further limits inventory, ensuring prices stay elevated. And if nothing changes, this trend will continue to lock out future generations from the housing market. But these issues go beyond supply and demand. They're systemic. Over the years, housing has shifted from being primarily about shelter to being a vehicle for profit. It's not just individual sellers hoping to cash in on rising prices, but the entire system. Policies favor developers building high-end homes or corporations buying housing stock as an investment rather than focusing on the needs of everyday people. When profit becomes the priority, affordability takes a backseat. The bottom line? The housing market is no longer built to serve people. It's geared toward maximizing profits. With a 5 million home shortage, prices aren't going to deflate unless serious changes are made to how we approach housing as a society. New policies or interventions could help, but they'll take time. And for now, higher prices are here to stay. So, where does that leave those who can't or don't want to buy? Renting has often been seen as a stepping stone to homeownership, but for many, it's becoming something else entirely, a permanent choice. Let's explore why some people are shifting their mindset around renting and whether it's as bad as it sounds. The rise of the forever renter. What happens when homeownership no longer feels achievable? For millions of Americans, the answer is simple. Renting becomes more than just a temporary solution. It becomes a lifestyle. A growing number of people are identifying as what some have called forever renters, a term that captures both the financial realities and emotional challenges of today's housing market. It's not just about being stuck. For many, it's about redefining what success and stability look like in a world where buying a home feels impossible. The financial barriers to owning a home today are daunting. Start with this. 64% of renters say they haven't saved enough for the down payment required to make that leap. And even if they could save, 48% believe high mortgage rates make buying unaffordable for them. These aren't abstract numbers. They reflect very real, everyday challenges. The difficulty isn't just about cutting costs and saving more. It's about competing against a system where income growth isn't keeping up with skyrocketing home prices. Think about it. The median price of a home is now over $428,000, while the median household income is around $74,600. With homes costing nearly 6 times the average yearly income, saving for a down payment and affording monthly mortgage payments feels more out of reach than ever. Take Ashley, a 29-year-old graphic designer living in Denver. She's been renting since she graduated college and has diligently saved 20% of her paycheck every month. After nearly a decade, she's managed to put away $25,000. But when she started looking for homes in her area, she realized her savings barely made a dent. High mortgage rates would stretch her budget to its very limit, leaving little room for anything else, like emergencies or even basic entertainment. It's not just the money, she says. It's the stress of knowing I'll always be one bad month away from losing what I worked so hard for. Stories like Ashley's highlight a broader reality. Even years of effort often don't add up to enough. And yet, not everyone who rents is deterred by finances alone. Some renters are embracing the flexibility and mobility that come with their lifestyle. Stephen and Marianne, a couple in their late 30s with no kids, decided to stay renters on purpose. They love moving every few years, and renting allows them to live in neighborhoods they could never afford to buy in. We value experiences over long-term commitments, Stephen explains. We'd rather travel and try new places than pour all our money into one house. For them, the cost of renting is worth the freedom it provides. A freedom they say won't go away when the plumbing breaks or the roof leaks. It's a trade-off, but one they feel works better than taking on the weight of homeownership. Interestingly, recent changes in the rental market have offered some relief to renters. During a construction boom over the past few years, median rents dipped slightly, down about 1.1%. This might sound like good news, but experts warn this trend isn't likely to last. One major reason for this is the rising cost of building new apartments. Many multifamily developments rely on imported materials, like steel and aluminum, which now face steep 25% tariffs. Add rising labor costs, and the result is fewer new apartment complexes being built, especially in areas where they're needed most. If supply slows down, rent prices could start climbing again, forcing people to spend even more of their income just to keep a roof over their heads. For most people, the decision to rent isn't made without a certain sense of disappointment. Many renters feel like they've been left behind, especially those who grew up in families that owned homes. For decades, owning property was considered a milestone, a clear marker of stability and success. But for those struggling to save or afford high monthly payments, the dream of homeownership feels unattainable, and that can take an emotional toll. Without equity, renting can feel temporary and precarious, especially when raising rent prices or an unexpected lease termination can uproot someone at any time. That lingering sense of instability is part of why renting has historically been viewed as a step backward instead of forward. But there's a noticeable shift in how people view long-term renting. For some, it's no longer synonymous with failure. A growing number of renters, especially among younger generations, are finding value in what homeownership lacks: flexibility. Some see it as freedom from ongoing maintenance costs and the financial responsibility of home repairs. Others like the ability to move without worrying about selling or uprooting financial investments. Renting can even open doors to lifestyle opportunities, like living in expensive cities close to work or entertainment hubs, that buying simply wouldn't allow on their budget. And while they're not building equity, Many renters argue they're saving for other priorities, like travel, starting businesses, or simply building a financial safety net. There are also deeper societal trends influencing this shift, like changing family structures. 50 years ago, most people in their late 20s and early 30s were married, many with kids, and looking to put down roots. Today, fewer than 60% of people in that age group live with a spouse or partner. This has delayed the timeline for buying homes, especially as the average age of first marriages continues to rise. Paired with crushing student loan debt and stagnant wages, more young people are staying renters longer or indefinitely. The forever renter lifestyle is transforming the American dream. For some, it's a reluctant reality, driven by financial hardship and an unforgiving market. But for others, it's a deliberate choice that reflects a broader shift in priorities. In either case, the rise of long-term renting is reshaping what financial security and success mean. Ownership may still hold social and financial appeal, but it's clear that renting is no longer just the step before buying. It's becoming a path of its own. So, if more people are choosing, or being forced, to rent, what options are left for those still dreaming of homeownership? Let's take a look at the creative solutions some are using to fight back against the odds. Creative solutions. Fighting back against the odds. When the odds feel stacked against you, creativity isn't just helpful, it's necessary. Across the country, aspiring homeowners are coming up with new ways to break into the market. These strategies range from splitting the cost with friends or family, moving to areas with cheaper housing, or buying fixer-uppers that require renovation before being livable. None of these solutions are easy, but they reflect the determination of people trying to make homeownership happen on their terms. Pooling resources has become one of the most popular ways to tackle affordability barriers. In fact, joint home purchases, especially among friends and unmarried couples, are on the rise. Back in 1985, unmarried couples accounted for just 4% of first-time homebuyers. But in 2022, they represented 18%. That's an enormous jump, and it highlights a shift in how people view both relationships and financial collaboration. Sharing a mortgage allows buyers to access neighborhoods or price points they wouldn't have been able to afford alone. It's not just couples who are doing this either. More families, and even close friends, are entering co-buying agreements, dividing both the cost and the responsibility that comes with owning a home. Then there's the strategy of moving to cheaper housing markets, a decision that's become increasingly common. While urban areas like New York and Los Angeles still attract buyers with bigger budgets, many are looking toward the South and Midwest for more affordable options. These regions have seen a major influx of people chasing affordability, which has, in turn, sparked home price growth in places that used to be overlooked. In fact, 80% of the zip codes projected for the highest increases in home values belong to the South. For those willing to relocate, this move often means leaving job opportunities, family, or the lifestyle they've known in exchange for a chance at building equity. Others are opting for fixer-uppers to cut costs. Purchasing a home that needs significant repair can lower the initial price, but it's not a simple solution. The cost of materials and labor for renovations has gone up, meaning these projects often require a significant budget and the patience to deal with unexpected hurdles. Still, more than 6 in 10 young people surveyed said they're open to buying fixer-uppers. For many, the potential for long-term value outweighs the challenges they might face in the short term. The sacrifices go beyond just pooling money or moving to a new town. Many buyers today are delaying major life milestones to pour all their energy and finances into homeownership. Some are choosing to hold off on having kids, getting married, or even retiring just to save for their first home. In fact, the average age of a first-time homebuyer has crept up to 38, which is 3 years older than it was just 2 years ago. This shift speaks volumes. It reflects how rising costs and stagnant wages have fundamentally changed the timeline for what most people would consider a traditional path to adulthood. Family support has also become a key factor for many young buyers. A striking 21% of Gen Z prospective homebuyers now say they plan to rely on family loans to help cover their down payments. That's compared to just 15% of the general population who report the same. For some, asking for financial help has become the only way to compete in a market where starter homes often come with prices that feel anything but starter. While this isn't a new phenomenon, it's becoming more common, and it underscores how economic disparities are forcing younger generations to lean more heavily on their families than previous generations ever did. Multi-generational households are another solution becoming more common. These living setups allow family members to pool their finances and share expenses, making homeownership more accessible for the whole group. This isn't just a trend in isolated cases. It's a growing response to economic pressure. For instance, adult children might live with their parents for longer, not only to save, but also to contribute toward a shared mortgage. Meanwhile, accessory dwelling units, or ADUs, have started gaining traction as a way to add flexibility to existing family homes. States like California have passed legislation, like Senate Bill 9, to make it easier for homeowners to build small units on their property as extra living space. These additions not only allow for more affordable housing solutions, but also reflect a broader shift toward collaborative and multifamily living. Even with all this creativity, systemic barriers continue to limit who can really access these options. Builders might be offering small incentives to make homes a bit more affordable, like financing deals with lower interest rates. But those discounts don't solve the bigger problem. Market prices are still too high for many to enter, even with help. And while co-buying, relocating, or depending on family might work for some, they're not realistic for everyone. These strategies also come with risks. Buying with friends can lead to complex agreements. Uprooting your life entirely can have long-term financial consequences, depending on where you move. While they're solutions, they don't eliminate the deep structural barriers keeping housing out of reach for so many. All of this highlights one truth. The housing market isn't failing because people have stopped trying. If anything, potential homeowners are becoming more creative and resourceful than ever. But resourcefulness alone can't fix a system that's increasingly designed to exclude. For every family that makes these workarounds successful, there are countless others still shut out of the market altogether. So, what does this mean for the future of housing? Is homeownership destined to remain a dream for many while renting becomes the new standard? Or can pressure on the system force real, meaningful change? Let's explore what might lie ahead. Will renting become the new normal? Is America becoming a nation of renters? It's a question that's becoming harder to ignore as the affordability crisis reshapes the housing market. For decades, homeownership symbolized stability, opportunity, and wealth. But with soaring home prices and rising interest rates, combined with wages that haven't kept pace, more and more people are being pushed toward renting. It's not just a temporary pivot anymore. It's beginning to look like a long-term shift. The implications go beyond individual lifestyles. This trend could redefine wealth, stability, and even what it means to pursue success in the U.S. The root of this change lies in an affordability crisis that has no easy solution. According to the National Association of Home Builders, NAHB, Nearly 75% of US households can't afford a median price new home. That kind of statistic shapes the market in profound ways. When that many people are priced out of buying, it creates a pyramid of affordability that leaves only the wealthiest households with realistic access to homeownership. And for those already struggling to compete, it becomes harder to believe that owning a home is within reach. Home prices aren't just high, they're out of sync with what most Americans actually earn. Adding to the challenge are growing costs that many don't consider at first: rising insurance premiums and climate adaptation expenses. As homes are increasingly impacted by natural disasters like wildfires and hurricanes, homeowners are footing bigger bills to protect their properties or rebuild after damage. In some high-risk areas, insurance rates are surging so fast that the cost of maintaining a home can rival what renters pay in annual rent. For many people, these extra costs make renting look more appealing, even if it comes with its own set of challenges. This affordability issue coincides with another key shift: the rise of corporate ownership in the housing market. Across the country, private equity firms and corporations have purchased thousands of single-family homes, driving up prices and turning what used to be starter homes into long-term rentals. These companies often target housing markets in growing cities, snapping up available properties and converting them into rental units, which reduces the chances for everyday buyers to enter the market. As a result, the opportunities for first-time buyers are shrinking as housing stock becomes increasingly concentrated in the hands of institutional investors. On top of these systemic issues, we're also seeing cultural and demographic changes that are driving the rental trend. Multifamily living is becoming more common, largely as a response to economic conditions. Younger generations, for example, are delaying major life events like marriage, having kids, or settling in one place. This creates a demand for apartments and smaller rental units that cater to a more flexible, mobile lifestyle. It's not just about affordability, it's also about choice. Many renters value the ability to move frequently, avoid the costs of home maintenance, and live in high-demand areas that might be out of reach if they were trying to buy. It's a different kind of stability, one tied less to ownership and more to freedom. Still, the numbers don't look great for renters either. While rent prices dipped slightly in a few markets due to a recent construction boom, experts warn that the relief might not last. The demand for rental properties is outpacing new supply in many cities, and rental vacancy rates are expected to continue declining in growing regions like Edmonton, where population growth drives the market. As demand pushes rents higher, renters may find themselves spending a larger share of their income on housing, perpetuating a cycle that leaves them with less to save for a down payment or other long-term goals. Even if the rental trend becomes a long-term reality for most people, the implications could extend far beyond individual households. Wealth inequality is likely to grow. Historically, homeownership has been one of the most powerful ways to build generational wealth. Owning a home allows families to build equity over time while providing a stable place to live. Without this opportunity, renters miss out on one of the few financial safety nets that have truly helped the middle class for decades. When families rent instead of own, they don't benefit from the same long-term financial gains, leaving them more vulnerable to economic setbacks. So, where does all of this leave us? Experts predict that housing affordability will only improve gradually over time, if at all. While government programs and reforms could help lower-income buyers, the broader affordability crisis isn't something that can be solved overnight. That means the gap between renters and homeowners is likely to widen, with each group experiencing drastically different financial realities. Homeowners will continue to build equity, benefiting from rising home values over time, while most renters will keep putting money into properties they don't own, essentially paying someone else's mortgage. The critical question is whether renting becomes the default way of living for future generations. Could homeownership phase out as the ultimate goal for Americans? Some argue it's possible, as long as the costs of buying remain out of reach for such a significant portion of the population. Renting might cease to be viewed as a temporary situation. Instead, we could see a shift toward more rental-friendly policies, more multi-generational housing, and a culture that places less emphasis on property ownership altogether. The future of the housing market might be less about ownership and more about adaptability. Fewer people will see renting as a stepping stone, and more will approach it as a permanent choice. Whether that's good or bad depends on your perspective, but one thing is clear: the housing market is fundamentally changing. For better or worse, the stability that homeownership once promised is evolving into something else entirely. So, what does this all mean for you? Let's talk about what you can do to navigate these changes and make informed decisions about your housing future. The housing market might feel overwhelming, but understanding the trends gives you a stronger position to plan ahead. Experts predict home prices will keep rising by about 3% annually, with mortgage rates holding steady around 6.5%. This means you'll need to be strategic, whether it's saving for a down payment, exploring more affordable areas, or negotiating better terms if you're renting. These shifts aren't just numbers. They shape decisions that affect your future. Will the American dream of homeownership adapt to new realities or fade into history? That's the question we're all facing as this market continues to challenge traditional expectations.